Turkey has experienced substantial economic turbulence over the last decade, largely influenced by President Recep Tayyip Erdoğan's unconventional policies regarding interest rates and inflation. Erdogan thought by prioritizing low interest rates, he thought he could boost economic growth. However, this resulted in unprecedented inflation rates and a sharp depreciation of the Turkish lira. In response to this crisis, Turkey's government has since reverted to more traditional economic policies by embracing higher interest rates and tightening monetary measures to regain stability. The IMF is also advising on structural reforms and fiscal discipline to stabilize inflation, strengthen the lira, and overall restore investor confidence. Although early indicators are promising, such as credit rating upgrades and improved export performance, Turkey's economic future remains uncertain and faces challenges with high inflation and public dissatisfaction. Turkey's economy has faced significant turmoil over recent years, largely driven by the president's actions and unconventional approach to the country's monetary policy. Traditionally, central banks raise interest rates to curb inflation, but Erdogan has long asserted that interest rates stifle economic growth and that low rates can also reduce inflation. This stance against conventional economic theory led to a period of aggressive interest rate cuts intended to stimulate growth and investment. However, in 2022, these cuts fueled rapid inflation and resulted in one of the highest rates globally, exceeding over 85%. And this policy of maintaining interest rates low diminished investor confidence and resulted in capital outflow in Turkey. The Turkish lira depreciated sharply, making imports more expensive and severely impacting the cost of living and economic stability. This made prices rise and eroded household and business power and created widespread financial strain across Turkish society. In response to the crisis, Erdogan signaled a shift toward more conventional policies in mid-2023 following his election. The Central Bank of Turkey, now under new leadership, implemented interest rate hikes, increasing the benchmark rate around from 85.8.5% to 30% by September 2023. These measures aim to stabilize the lira, control inflation, and restore investor confidence overall. Additionally, these changes received positive responses from international credit agencies, with credit rating upgrades reflecting this cautious optimism about Turkey's economic future. Also, the IMF, International Monetary Fund, has played a huge role in monitoring and guiding Turkey uh, throughout these economic shifts. Turkey has had a long history with IMF, having sought assistance before during previous financial crises. And for example, the 2001 financial crisis, Turkey implemented IMF-backed reforms, leading to actually a period of economic growth and stabilization. While Turkey hasn't taken IMF financial support in recent years, its current policy direction has been largely influenced by IMF recommendations, such as maintaining tight monetary policies, avoiding inflationary wage increases. The IMF has also advised on structural reforms, including reducing energy subsidies and enhancing renewable energy production to build a more resilient economy overall. And Turkey's economy has been recently been making significant changes, and this can be seen through significant policy shifts, credit rating upgrades, and fluctuating economic indicators. In the first quarter of 2024, Turkey's economy grew by 5.7%, making it among the world's fastest growing economies in the world. However, this rapid growth is expected to settle with projections around 3.2% for 2024 and 2.6 in 2025. before rebounding to another 3.8% the following years, according to the World Bank Group. Inflation, a continuing challenge, has peaked over 8.5% in 2022, but recent efforts to tighten monetary policy have indicated by September 2024, inflation dropped by below 50%, which is the slowest pace in over a year. The Central Bank of Turkey has continued to implement a conservative monetary stance, keeping the benchmark interest rate high around 50% to control inflation. And this approach contributed to reserve accumulation and a gradual process of disinflation. Additionally, it has led to credit rating upgrades and promoted positive responses from international credit agencies. For example, in September 2024, Fitch, one of the big three credit rating agencies, upgraded Turkey's rating from a BB minus to a B plus in November 2024. Turkey's export performance has also been strong. In October 2024, exports reached a record 23.6 million, and the current account deficit narrowing substantially also, dropping to about 9.7 billion and from January to August 2024 compared to the 55 billion in the same period of the previous year. Overall, this improvement reflects a recovery in trade balances and a positive outlook for the economy. The International Monetary Fund has also continued to monitor and influence Turkey's economic policies and performance. In its 2024 Article 4 consultation, the IMF acknowledged Turkey's effective policy tightening since mid-2023, noting improvements in macroeconomic stability and investor confidence. The IMF has also advised Turkey to continue its tight, data-driven monetary policy until inflation reaches target levels. This includes avoiding large minimum wage hikes that could reignite inflation. It also suggests focusing on targeted social programs for low-income households and increasing renewable energy production and reducing energy subsidies to mitigate vulnerabilities from the energy price shocks. Turkey's economic situation depends on maintaining monetary discipline, implementing IMF recommended structural reforms, and adapting to global pressures.